Warren Buffett has just issued a warning about the property market, and you will want to understand. In 2012, he stated that he would buy hundreds of houses if it were feasible. Today, he claims that properties are not worth the investment, and coming from someone who has outperformed the market for decades, this shift deserves attention. In this video, you will discover exactly what lies behind this decision. Buffett never built his fortune by predicting crises. He himself admits that he does not try to anticipate recessions, bubbles, or market crashes. Instead, his strategy has always been based on enduring fundamentals, companies that generate cash consistently, and a portfolio structure prepared to withstand and even benefit from economic cycles. It is a simple yet powerful logic. If you are always ready, a crisis ceases to be a risk and becomes a rare opportunity to accelerate your results. In 2012, Warren Buffett stated that if it were practical, he would buy hundreds of residential properties. Prices were low, credit was cheap, and the economic recovery was already showing signs of consistency. In his view, it was an almost ideal scenario. Properties with strong appreciation potential, financed at fixed rates of 3% per year with decades ahead. Today, however, Buffett avoids the sector, and not by chance. The shift has been as drastic as it is revealing. But what did he see? That the majority still ignores? The answer lies in the mathematics and in capital efficiency. Historically, properties in the USA and Europe appreciated around 4.3% per year. This is just a bit above the average long-term inflation rate. It seems solid, but hides a crucial detail. This number does not take into account taxes, maintenance costs, vacancies, insurance, renovations, and most importantly, the opportunity cost of having money tied up in an illiquid asset. It looks good on the spreadsheet until you put down on paper all the invisible costs. And then the outcome can be shocking. And Buffett knows this. For him, the great differential of properties has always been leverage, buying with bank money and multiplying personal capital. But with rising interest rates, this benefit becomes a trap. Moreover, properties demand time, attention, and active management. It is not just about buying and waiting. It is about searching, negotiating, renovating, renting, dealing with tenants, dealing with regulatory bodies, contracts, and bureaucracy. All of this consumes energy that could be allocated to assets that scale much more easily, such as publicly listed companies. And there is another subtle yet powerful point. The real estate market is deeply emotional. Each sale is an individual negotiation laden with subjective decisions, long timelines, and unpredictability. For Buffett, this is the opposite of what he seeks: liquidity, objectivity, and operational efficiency. In crises, this difference becomes even clearer. Properties decline, but rarely plummet. Volatility is lower, which may seem positive, but Buffett sees it as a limitation. It is precisely in deep declines that the greatest asymmetries arise, and they are almost always in the stock market. Today, with stagnating property prices, high financing costs, and reduced return predictability, the scenario has changed, and for him, it has ceased to be worthwhile. In Europe, the context is no different. In major cities, property prices remain high, but net returns are increasingly compressed by regulations, taxes, and charges. Buffett does not say that properties are bad, but with the capital he has and the time that appreciates, he prefers to invest where the asymmetry is greater. And here is the key point. He only considered investing in properties when three conditions were present simultaneously. First, prices were at historical lows. Second, financing was accessible and predictable for decades. Third, the economic recovery already offered a clear appreciation horizon. Today, none of these factors exist. Well-allocated capital, for Buffett, goes where there is a margin of safety, and potential returns exceed risk. But if not in properties, where's this room for maneuver? That is what we will see now. Warren Buffett is known for having billions of euro in cash. At first glance, this may seem overly conservative. After all, leaving money idle means losing purchasing power over time, right? However, this apparent contradiction is actually one of the keys to his strategy. He does not hold cash out of fear. He holds it for strategic reasons. When the market panics and solid assets are sold at irrational prices, those with liquidity become kings. During the 2008 crisis, while many investors rushed to protect themselves, Buffett used his reserves to buy entire companies or parts of them at discounts that would never be available in normal times. This happened again, to a lesser extent, during the 2020 crisis. And this mindset applies not only to billionaires. For the average investor, the concept is the same. Maintaining a strategic reserve in highly liquid assets means being ready to act when the market presents rare opportunities. As Buffett himself says, the best purchase is made when others sell out of desperation. And this type of purchase is only possible when you have cash on hand. Even if this liquidity loses a bit against inflation in the short term, the value of future opportunities outweighs the loss. But is it really worth it? Let us compare two investors. Imagine both have €100,000. The first leaves the money in cash, earning 1.5% per year. After 4 years, he ends up with approximately €106,000. In the fifth year, the market drops by 30%, and that is when he enters. With a subsequent 50% recovery, the final value rises to €159,000. Adjusted for inflation at 4% per year, this equates to €130,770 in real value. The second investor invests the €100,000 from the start in an equity fund that yields 7% per year. After 4 years, he accumulates €131,000. However, in the fifth year comes the 30% drop, followed by the 50% rise. The final value settles at €137,635. Adjusted for inflation, the total falls to €113,097. In the end, the investor who waited ended up with a net advantage of nearly 15%, even after 4 years of returns below inflation. This is the type of asymmetry that Buffett seeks. But what should be done with this liquidity when the right moment arrives? And what types of assets does he prioritize when everyone is selling? When the market trembles, Buffett returns to basics. Businesses that continue to generate money, even in difficult scenarios. Companies with indispensable products, consistent margins, and a customer base that does not disappear overnight. This is why he maintained and reinforced positions in companies such as Coca-Cola and American Express. Even during recessions or pandemics, these companies continued to be profitable because they offer something that people continue to consume, regardless of the phase of the economic cycle. If a company can weather a tough period without needing to raise capital urgently, it survives and comes out stronger. This type of business also tends to have pricing power. That is, even when costs rise, they can pass some of that on to customers, a critical factor in times of inflation. But perhaps the most important aspect is this. They are easy to understand businesses. This reduces surprises and strengthens conviction when it comes to maintaining the position. And when the portfolio consists of resilient companies, it also becomes easier to manage. Which brings us to the next point of Buffett's strategy. Buffett is frequently asked why he does not invest in cryptocurrencies, technology startups, or complex assets. His answer is usually straightforward. He avoids what he does not understand. His philosophy is simple, but it requires discipline. He looks for businesses that anyone can explain in a sentence, and that will continue to exist, profit, and grow over the coming decades. No speculative bets or attempts to predict the future. This approach brings a little discussed advantage: mental clarity. For those with a busy schedule, family, career, or other commitments, this is liberating. You know what you own, why you bought it, and what to expect in the long term. Overly complicated strategies often lead to paralysis. Buffett knows this. Therefore, instead of chasing the next miraculous asset, he spends more time studying what already works. This simplicity allows for another powerful benefit: scalability. Because the simpler your strategy, the easier it will be to replicate it over the years, with consistency. But it is not just the investment that matters. The time you spend on it does as well. Buffett understands that the scarcest resource is not money, it is time. And this detail completely alters the way he chooses where to invest. Real estate may seem like stable investments, but they require constant attention. From the bureaucracy involved in purchasing to tenant management, preventive maintenance, renovations, and contract negotiations. Each property becomes a micromanagement task, and this scales poorly. In contrast, well-selected stocks allow for automation. Dividends are reinvested with a few clicks, there are no midnight phone calls to resolve leaks, and capital appreciation occurs without operational effort. The difference becomes clear when we measure the return per hour invested. A medium-sized property may require 10 hours of attention per month. Conversely, a well-structured portfolio in stocks can be reviewed in 10 minutes per year and still generate superior returns. Buffett applies this logic not only to capital, but also to his own lifestyle. He prefers a system that operates almost on its own, without relying on his constant presence. But even with all of this, he does not invest at any price. He waits. But when this crisis arrives, he does not freeze. He acts, not because he is sure he's found the bottom, but because the price has become cheap enough. This is how he defines the moment to enter, when the quality of the asset outweighs the risk so evidently that waiting longer would be a waste of opportunity. He looks for resilient companies with predictable profits, good management, and a margin of safety. And it is exactly this set of criteria that protects the capital and allows it to multiply in the subsequent phases. It is not about hitting the perfect moment, but recognizing when an asset is priced irrationally in relation to its real value. At these times, the discipline of maintaining a reserve and following the plan makes all the difference. It is when the panic of others turns into opportunity for those who are prepared. That is why Buffett is currently avoiding buying houses. They are not a good opportunity. And this is perhaps the most powerful lesson for those seeking security and lasting growth. It seems simple, but it is precisely this that makes Buffett's results so difficult to replicate. If this video has helped you see this more clearly, subscribe to the channel to receive upcoming content, and like this video to help this message reach more people. Because in the end, investing well is not about guessing. It is about resisting and having a strategy. And doing this consistently changes everything. We will see you in the next video.